This week, we're going to focus on Chapter 5, which the good news is that there's no new economic model that we're adding to our repertoire or to our overall macro model, or no new markets, I should say. But we're going to use what we developed in Chapter 4, the goods market, the saving and investment diagrams, to add the rest of the world into our model. In Chapter 4, we were making the assumption that we had a closed economy, that there were not any other savers or investor or firms deciding on capital, or people making consumption decisions from the rest of the world. Right? It was just the domestic economy that we were focusing on. That was the assumption. So we're opening up that assumption in this chapter. We're adding the rest of the world, and to see how that helps us understand some more connections and makes our model even a bit more realistic. So we're not adding any new markets, but rather we're using the market that we just developed and looking at that, but through the lens of the international economy. So I'm going to share the screen. I'm going to take us out to the textbook, and let's take a journey through this chapter and look at the things that in particular you should focus on. So here is the table of contents for Chapter 5, Saving and Investment in the Open Economy. We'll look at the left-hand side here. You'll see that there are 5 different sections in this chapter, but in reality, there are really 2 things in this chapter, really. The balance of payments accounting section, we'll talk about that in just a moment. And then goods market equilibrium in an open economy. So instead of in Chapter 4, where we looked at the place where desired saving and desired investment intersected, that's the equilibrium in a closed economy with no other international players in this market. That is no longer going to be the case, and that is the big difference in this chapter. It's one of the few places in economics where I can say where the equilibrium doesn't necessarily and generally doesn't occur where 2 lines cross. And so that's the part that's going to be really important for you to focus on and to understand in this chapter. There are other additional sections here, but they're really subpoints of the idea of goods market equilibrium in an open economy. So the first case is one where we have a small open economy. And then the second part, the next part of that, is when we have a large open economy. Now, it gets a little more complex in that second case, but that's the one that we really want to focus on. We're going to add another graph, but it's really just adding the international component to it. It's not adding another market to our model. And then the last part is focusing in particular on a particular type of example, a particular type of way that we can look at this model to help us get a better understanding, a more realistic understanding of what the impacts in this case are of fiscal policy. Fiscal policy has to do with taxing and spending by the government, federal government. And we want to look at what are the impacts of changes in taxes and spending on the international economy, in particular, the current account, as it says there. The current account is really, for our purposes, the net exports for our trade deficit or our trade surplus in the economy. So that's really the outline for this chapter. It's really just understanding what balance of payments accounting means. How do we account for payments between countries? And then what does that imply about our model and what we mean by equilibrium in the goods market when we add an international component to that? So once we get past the learning objectives for the economy, but let's go to the first section, section 5.1. So what do we mean by the balance of payments? Right, that's what we want to focus on here. All right, the balance of payments is made up of the current account and made up of the financial account. Right, there are 2 components to this. The ideas are fairly straightforward. The current account is about the net export of goods and services. So imports and exports, net exports of goods and services. So those are currently produced things, goods and services in the economy. And then we also include net income from abroad, which income receipts from people working abroad, minus income payments that go to residents of other countries that may be working in this country. So I can let me tell you ahead of time, we're going to assume for our model that these net factor payments are essentially zero. That's not true, of course, but it makes the model simpler to think about. And if we assume that there's zero, then all we have are exports and imports of goods and services. And you can see that the exports and the imports overall, right, are they're 10 times higher, more than 10 times higher than net income from abroad. Okay. This is a smaller component. We could add it back in, but for our purposes, we really want to focus on is this sort of more, a little bit more simplified model. And it's also got unilateral transfers as well. We'll assume those generally are zero. These are gifts from one country to another, right, of income, right? So the other side of the balance of payments, right? People pay in the United States pay foreigners, foreign citizens, right, for goods and services, and likewise foreigners pay US citizens for goods and services. But that's not the only reason that payments happen between countries. They can also happen, these financial flows can happen due to assets. So assets are things that have value, but aren't part of GDP. They're things that were produced or they could be things that were produced previously, or they could be financial assets. They could be real, that is things like buildings or land, real estate, or they could be financial assets, right? So they're not part of, they're not part of GDP, whereas the part in the current account is. Right, so payments go back and forth between countries to pay for assets, right? Like stocks, bonds. If somebody in another country buys some real estate in the United States, an office building, or they put up a manufacturing plant for cars, for example. And likewise, when there are US companies that go to other countries and set up a manufacturing facility, let's say in another country. So what we're doing in these things is we're following the dollar flows. Dollars are flowing in or dollars are flowing out. That's the easiest way and best way to think about the balance of payments, and then think about, well, what are those dollars flowing in or out for? Is it to buy goods and services, or is it to buy buy and sell real and financial assets? Right? Stocks, bonds, treasury bonds for the US government, real estate, warehouses, factories, etc. Okay? So those two go together. That's sort of a big picture view of the balance of payments. And then we look at each component of that, right? We break it down in the way that I was just talking about with the current account. We've got net income from abroad, unilateral transfers, right? And then we have the current account balance. And then we can go to the financial account, right? These are subsections of this first section in chapter 5. And you want to pay a particular attention to this to get a really good understanding of what we're talking about when we're talking about the financial account. And the dollars are flowing in, right? You see outflow or inflow, right? It's where the funds are going, where the dollars are going, right, is what's getting accounted for in the balance of payments. Okay, so like it says here, when the home country, let's call it the US, buys an asset from somebody else in another country, right? In this case, a Swiss bank account, but it could be buying stocks in Germany, whatever, some kind of financial transaction. That's a financial outflow because the dollars are going out of the country, right? And that's recorded as an increase in US own assets abroad. So in essence, we're lending money to another country in that case, right? When dollars are flowing into the US, somebody in another country is buying something from the US, right? So those are, and we're selling something, right? Could be goods and services in the current account, or it could be a stock in a company, private stock in a company, could be a US Treasury bond. It could be selling, opening a bank account here. It could be selling a business in the United States to somebody abroad. So the dollars are coming into the US in that case, right? And those are entered in the balance of payments with a plus since they're coming in, adding to, whereas dollar outflows are with a minus sign, right? So that's one way to kind of keep that straight. Which way are the dollars flowing? And then to ask, what are they flowing for? Are dollars coming in because somebody's buying US exports, right? Goods and services, that's a plus in the current account, right? Or are they coming in to buy, say, a US stock, right? A share of Microsoft stock by somebody in Japan. In that case, dollars are flowing in to buy the stock, and that's a plus in the financial account. Okay. So the balance of payments is accounting for both of those kinds of dollar flows, right? So it's a way to keep record of that. All right, now, so it's useful to think about that in particular in this subsection, because what's got to be true is that the two accounts have to balance out. That's why it's called the balance of payment. Well, it's called the balance of payments, but it's a balance, right? It's a balance account, right? So what that means is that the current account has a positive value, means more dollars are coming in to buy our exports than are going out to buy imports. Then that's got to be offset by a negative in the financial account, a deficit in the financial account, meaning more dollars are flowing out to other countries than are coming back, and vice versa. Okay, so that relationship is really, really important in this chapter. It's important that you understand that and can explain it, and it's important because it's going to also play a role in our model, in our graphical model. Right, so that's one of the things to pay attention to. And then we've got some, there's an example of why that has to be the case, right? So it's important for you to understand why that's the case. The general idea is that let's give one simple example. With dollars are being paid out to buy goods and services to some Chinese company, let's say. Those dollars, if they're not coming back to buy our goods and services, right, our exports, we're importing more from China, but they're not importing as much from the US. We're not exporting as much to balance the current account. That means dollars are building up in Chinese hands. Those dollars don't earn any return, so the Chinese would like to put that money to use. What do? If they're not buying, if the country's not buying enough US goods to offset and to use those dollars, then they're going to be used for buying US government treasury bonds, they're going to be used for buying US private stock, they're going to be used for buying US real estate, they're going to be used for putting up a new car production facility in the US, any of those kinds of things, right? That's the idea. That's the general idea. So, and now we can think about the balance of payments accounts overall, right? And what's happening to the net foreign assets, right? Like it says, net foreign assets are part of a country's national wealth, along with the physical assets. So what happens with the balance of payments has implications for net foreign assets, and that has implications for a country's national wealth. Right, so that's the connection. So, for example, if you string all this together, the logic, trade deficits or trade surpluses, but we've mainly had trade deficits in the U.S. over the last 30 years, right? So that is a negative, ends up being a negative in the current account, a positive in the financial account, meaning more dollars are flowing in to the US to buy financial assets like government treasury bonds that are going out. And so we are essentially borrowing from other countries in that case to pay for our current account deficit. So if we're borrowing, then as we we'll learn here and talk about in just a moment, we'll talk about this in terms of the goods market equilibrium. We can use our uses of saving identity. We learned about back in chapter 2 when I said that was going to be an important thing to pay attention to, that we can use that to think about, for example, what's the impact at the end of this chapter, what's the impact of increases in government budget deficits? What do they do to our country's wealth? All right. And partly that has to do with what the government's spending the money on. So if they're running budget deficits, they're printing government bonds. If other countries are buying those bonds in the open market, they're essentially lending to the US. And the question then is, what are we doing with that, with those funds? Right? What is the government actually spending the money on? Is it using it to put in new infrastructure? Is it using it to increase unemployment benefits? What is it using the money for? So and that has implications for overall the wealth of a country over time. And that's what this section is about. Okay. So that's the first section about the balance of payments. Once we get to talking about the goods market in equilibrium in an open economy, right? The uses of saving identity, which is what this is building up here as I'm going through this. This is where this is really where we end up, right? That if we assume that net factor payments are 0, right? We have desired saving equals investment plus the current account. This is what we have back from chapter 2, right? This part up here in that equation 5.3. But if we assume the current account is simply net exports, because we're assuming that factor payments and unilateral transfers are 0, then it just becomes saving equals investment plus net exports. So what it means then, if you bring investment to the other side, subtract it from both sides, we have saving minus investment equals net exports. So on a graph, the horizontal distance between desired saving and desired investment at a given interest rate represents the level of net exports, the country's trade surplus or trade deficit. It's really important. That's how to translate this equation into the graph that we're going to use in the rest of the chapter, which is the one we had in chapter 4, but we're not necessarily going to be at a place where saving equals investment anymore, right? Because we assumed before that net exports were 0. It was a closed economy. That's what it meant to be at the place where these two lines cross. That's not necessarily going to be the case in this chapter. And then this points out the net exports really, what does it mean, right? So this is all the spending on goods and services in an economy: consumer spending, firm spending, and government spending. Here's the level of income, or GDP, and the difference between the spending and the supply. Essentially, this is the supply of goods and services produced in the economy. This is the amount of expenditure on goods and services. The difference between those is made up from net exports. Okay? So what it means actually is that if spending in the economy is greater than the economy's output, right, C plus I plus G is greater than Y, then this is going to be negative. Y minus that number is going to be negative. Real GDP minus that number is going to be negative. So that means net exports are negative in that case. What does that mean? That means net exports are exports minus imports. It means that imports are greater than exports. It means we have a trade deficit. It means that we can, net export, a trade deficit allows us to buy more goods and services than we can produce ourselves as a closed economy. Okay? So having a trade deficit means that we can have more stuff. We can buy more stuff than we actually produce ourselves in the economy. Okay. So the next two sections are really subsections in a sense, right? We're in this section, small open economy. We assume that the world interest rate, what the interest rate that matters now is the world interest rate. And we're just going to assume that a small country takes the world interest rate as given. Their own actions in their country don't affect the world interest rate. They're just too small to have an influence on that. And so what that means graphically is that if this is that, we have to know whatever the world interest rate is. And once that's given, we can just draw a horizontal line. And the difference, remember, between saving and investment, right, at the given interest rate, right, is net exports, right? In this case, saving is greater than desired investment at this real world interest rate. That means that they have excess saving, excess dollars. If it was the U.S., the U.S. is a large country, so this model really won't apply to the U.S., right? But it would apply to, say, a less developed country, and they have more saving than productive uses for it, in terms of capital in that country, and so they can be a net lender. Saving is greater than desired investment. And so what that means is net exports are positive. If we went back to the last section, if net exports are positive, it means the financial account is negative, right? To use the first section. And it means that more dollars are flowing out in terms of lending for financial assets than are coming back. And so the country's a net lender in that case. So, and so here's the opposite situation, all right? They're a net borrower when investment is greater than saving. It's important to understand that and why that's the case. And it's important to go back to the section 5.2 and then section 5.1 to really connect those ideas. I make sure you understand that. Okay. So now we can think about, well, what happens if there's a shock? Well, economic shock just means a shift in a curve. So if there's a shift in a curve, the country's too small to affect the real world interest rate. So the question is, what happens to the distance between desired saving and desired investment at that real world interest rate? The real world interest rate is not going to change. The country's just too small to affect that rate. And so now we can say, well, what's happened to saving? What's happened to investment? The interesting thing, nothing's going to happen to investment here. If we drew a line down, right, that hasn't changed when this curve shift, but the quantity of saving has declined, right? And also it's the case that the current account surplus has gotten smaller too, the difference between those two lines, right? So now it's really the difference between those two lines that we're interested in and what it says about the country's current account. So we've added another variable into our model, essentially, right? The current account, which also means the financial account, because the two are connected. One's just the negative of the other. Okay, and we can also think about that in terms of net lending and net borrowing. So in a large open economy, that's the one where you really need to spend time really understanding the diagrams and how they fit together. And what does equilibrium mean, excuse me, in a large open economy? So this figure 5.5 is one that you really need to have a good understanding of, and why it represents equilibrium. So this world interest rate, so here's two countries. Here's the home country. Here is a foreign country, right? Home and foreign. And so in the world economy, right, what we're saying here, right, since the investment's got to equal the net exports plus desired saving has to equal desired investment plus net exports in each country, right? So we can think about that and put it in the context of what does it mean in the world economy? Well, when we actually unbundle that, it means that one country's lending has to equal another country's borrowing, right? So the difference between, remember, between desired saving and desired investment is a country's net exports, right? Here in this case, the country is going to be a net lender, right? And so in the other case, going to be a net borrower, have a current account deficit. So it's putting into place the material that's in the first part of this chapter, understanding what it means if you're above the equilibrium here and below, but it's really what's the difference between these two lines, desired saving and desired investment, right? And that's simply net exports. And then it's making sure that you understand whether the net exports are positive or whether they're negative. One country's positive net exports have to be offset by the other country's negative net exports. If that's not the case, for example, at 6% in this diagram, right, the difference here, right, is less than the difference here between these two, right? So in the home country, desired saving is bigger than desired investment by 300 billion, right? So that's they have excess saving. They're a net lender in that case, and so their financial account is negative. Their current account is positive in that case, right? In this case, the amount of excess saving in the world economy is greater than the excess demand for borrowing, right? Desired investment is greater than the amount of saving that's available in this country at that interest rate. And so what's going to happen? There's an excess overall. There's an excess saving, right? This is the lack of saving, 100 billion, excess saving, 300 billion, right? There's a surplus of saving in the world. Interest rate's going to come down because whenever there's a surplus. When is it going to stop coming down? When one country's surplus is just equal to the other country's deficit in terms of the difference between saving and investment. Okay? So this is the equilibrium. It's not where if each country was alone, it would be where the lines cross. But in the world economy now, an open economy, it's in between those two interest rates that would prevail in a closed economy. And it's where one country's excess saving is equal to another country's excess demand for investment. So that's really the basic idea in the large open economy. This is just explaining that, going through and explaining that. So I encourage you to really pay attention and really dig into this section 5.4. This is kind of just going through and relating this to the actual economy. And then the question then becomes, well, what happens when there are shifts in the curves, right? That's always the question, right? So when there are shifts in a curve, right, then in the small open economy, right, a bigger budget deficit, for example, that reduces national saving, right, it causes the current account surplus in this country to get smaller, right, if the real world interest rate was up here, okay. So what happens in the large open economy? Well, the same thing happens in let's say in the home country, right? But now, let's look at this in terms of the subsection, right? So what happens when there's a tax cut, right? We're doing the same things that we've been doing. We ask a question, something happens, which curve, which way, what's the impact? Right? It's the same exact idea here. So this is some background in terms of how budget deficits and trade deficits are related. So the question is our model consistent with that? So what happens? Are trade and budget deficits related? Right? That's the question in this box. It's called the twin deficit. So that suggests that they are related. I can tell you, you will have some kind of question on your next exam related to the role of budget deficits and how they affect the economy. We had one on the first exam. You'll have another one on the next exam, and it'll be related to this idea of a large open economy, because we can analyze that question in this context. You'll have a homework question about that as well. So that's really the whole chapter. It's not, there's nothing new in terms of a new model, a new market. It's using the model that we have, the market that we have, just the goods market, just looking at that alone and understanding that market from an international perspective. So all we're doing is we're relaxing the assumption that we had a closed economy, which is what we assumed in chapter 4. It's the only thing we've done is we've taken away that assumption. And now we can go back and use the uses of saving identity that we had back in chapter 2. We can think about the things that cause curves to shift in the goods market that we looked at in chapter 4. And we can put those together to talk about what impact those kinds of shifts have, not just on domestic investment and saving in the real world, in the real interest rate, but now we can also talk about it in terms of how it affects our current account balance. And we can also talk about how it affects the level of investment and saving in other countries. Right? So that's what we've added on. We've added a little more real worldness to our model. And it's important to have practice with that. So that is a summary of this chapter. I really do encourage you to look at the key diagrams at the end of each chapter, key equations, right? And to really get a good understanding of that. There's a summary. I know there's a summary table in this chapter as well that summarizes in one table. I believe it's summary table 7 in the balance of payments accounting section of the chapter. Let's see if I can. Maybe at the end of this. I don't remember exactly. Yes, here's summary table 7. It's important to understand how each item in this table is saying the same thing. There are just 5 different ways of saying the same thing. And it's really important that you really dissect that and really understand why that is the case. Right? So this is actually in the very first section. It's the last subsection in the first section of chapter 5.